Uh, just a hearty word of welcome to everybody, and I hope we're going to have a very productive meeting because we need to be able to collaborate and to make things work in the value chain for agriculture. And hopefully we can get through this COVID-19 pandemic without too much loss.
Thank you, Pierre. Okay, so first up on the agenda is Nikki. Nikki is just going to give us a view on the economy and what is happening currently with regards to our own economy and how she see things playing out. And so we'll give every speaker a chance, and then in the end we can take questions. So it's a little bit like a speed date. So if you're not speaking, mute your phone or your computer and put off your video. Okay, Nikki, you're up next.
Hello, so let me first check, can everybody see the presentation?
Not yet.
No.
Okay. All right, so that's a bit annoying. Okay, let me see what I can do. All right. I thought we had that sorted. Okay.
Check there on the share screen. Pierre, you can put your camera off.
Yeah, that's the thing. It was sharing, but I think that because I have a second screen, it might be going to the second screen. So perhaps, let me just have a look here. Share. Now, can you see it?
Yes.
Okay, so if I do it like, if I run through it like this, because the moment I have to, if I'm going to go on presentation mode, it's going to go to the second screen, and I don't want to mess with that system now. So are you all right? You can see it like this?
Yes, we can.
Okay. All right. So let's start. On COVID, obviously, that's the theme of the day. It's dominating the entire global conversation, and it has introduced an enormous shock to the world economy and to the South African economy. So let's just run through the global impact. That is from the World Health Organization, and it literally shows you what has been the spread of the virus. If you look at the sort of dark blue areas, those are the epicenters. So obviously it started in China, and then the next epicenter was Europe, and now it appears like the third sort of epicenter of the crisis is the United States. The United States now have the largest number of confirmed cases of COVID-19, and they also have, of course, the largest number of fatalities as a result of COVID-19. So unfortunately, it has hit the world's first and biggest economy, that's the United States, the world's second largest economy, China, and then all your major advanced economies have been affected. And clearly that has very significant consequences for the world and for South Africa going forward. As far as the spread of COVID-19 is concerned, the good news is in most of your advanced countries, it does look as if the curve is turning. It looks as if we are either at the peak or very close to the peak of the virus. Then there are countries, of course, that's got the whole situation under control, that's done exceptionally well, the South Koreas, the Taiwans, and of course the Australia, which is not often mentioned, but Australia has done exceptionally well and seem to have the situation quite comfortably under control. If we look here, it shows you global infections. And if you just look at the cumulative confirmed cases, it looks like we're still very much stuck on the wrong side of an exponential curve. And yesterday's count, we were at over 2 million people that have contracted this virus across the globe. But the bit that's got the markets excited, the bit that everybody's watching, of course, is the rate of new infections, the so-called R. And if you take a moving average of that, it certainly appears as if globally, this represents global new infections. It does look as if the curve is near its peak and therefore about to turn. So your rate of new infections are slowing. Even in the United States, where the impact has been that dramatic, this shows you the US's rate of new infections, and the green line is essentially your moving average. And you can see it's clearly turned. So that's what the little lift in the market was all about of late. But of course, nothing decided. If you listen to the World Health Organization, they believe that COVID-19, despite evidence that in Spain, Italy, Germany, you know, and France, the United States, and even the UK, that the rate of new infections have turned. They don't believe that COVID-19 has been defeated. They believe there is a very strong possibility, unless the world is very careful, that you could have second or third waves of infections, especially since there is still no effective vaccine, which is obviously the best solution, the ideal solution to this problem. And secondly, because there is really also no consistent and effective treatment for COVID-19 other than dealing and managing the symptoms. So basically, the World Health Organization is still very weary and still very concerned. They are not recommending that countries remain in lockdown for an extended period of time, but they are recommending that people permanently change their behavior until there is either an effective treatment or a vaccine for this particular virus. So the whole notion here is that even when the lockdowns are gradually lifted, we will still have to get used to wearing masks, to carrying hand sanitizer with us, to keep a healthy distance from any other human being, whether we stand in a queue, whether we're at a shop, and whether we're in a factory situation. Now, of course, this has enormous ramifications for businesses because we're not designed that way. I mean, I work for a bank, we all sit on top of each other. And it was all this drive to reduce costs. Now, for example, in our dealing room, they've had to rearrange everything that there are 2 meters between every desk. We may have to put protective screening in where we didn't used to have it. So it will require, if we are going to start opening up this economy, which is essential, otherwise we will fold, that businesses adjust, that they as quickly as possible come up with innovative ways of putting in the necessary protective measures or rearrangements in order to make sure that production can continue, but without placing anyone at risk or enhancing the possibility that the virus can spread. All right, so that's COVID-19. The good news, at least, is that it does appear to be turning. Globally, the impact financially has been dramatic. In mid-March, the world woke up to the consequences and exactly how contagious this virus is and how easily it can spread. And of course, also containment measures were implemented, and they were very strict and they were very dramatic. And as a result, the market started to calculate that into company earnings, and we saw that equity prices across the globe literally imploded. Since then, there has been some correction. Some degree of calm have returned to the markets, last week especially, as there were signs that the virus is very near its peak, and that the rate of new infections have certainly slowed. What we have seen is that there was a bit of a lift as well last week in the global markets. And it doesn't matter which one you're looking at, whether it's the US, whether it's the FTSE 100 in the UK, whether it's the CAC 40 in France. everybody follows the same pattern. The most resilient of the bunch has been the yellow line, interestingly enough, which is, of course, China, which is where this virus originated. In the heat of the panic, virtually nothing satisfied investors. What they really wanted above all else was US dollars. And even your low risk government debt, we saw spiked. If you look at this graph here, you'll see from around the second week of March until around the 3rd of the March, in the heat of the storm, even we saw even that your bond yields for, Legion's gone here, but never mind. The bottom one, the green line, that's Germany. The red line is the United Kingdom, and the blue line is the United States. And you can see even US government debt, US treasuries, people were selling out of it and bond yields were spiking. Again, now, since the second week or so of March into April, we have seen some calming down, people returning to the bond market, and investment to some extent, well, adjusting to a new kind of normal. One of the biggest casualties of COVID-19, the literal drying up of demand across the globe as a result of things like economic lockdowns, shutdowns of factories, travel restrictions, has been the implosion in global oil prices. This shows you the Brent crude spot price, and you can see it is hovering around that sort of $20 a barrel level. If you look at American oil prices, you may have heard that on the futures contract yesterday, it hit a negative. In other words, you had a negative price. So in other words, oil producers in the United States were literally paying people to take their inventory off their hands. Now, the big reason for the difference between West Texas oil and, of course, your Brent spot is that West Texas oil is produced inland. And it is transported via pipelines, and the pipelines is full. Inventories are full, and literally what you found was that oil producers couldn't sell anymore, so they were literally paying people to take the stock off their hands. So a little bit of a disparity between those two, the Brent and the West Texas, but they both show a very depressed situation. And this is even after OPEC cut production quite dramatically. It's really had no impact. And the reason for that is because demand has imploded. Investors really chose in this crisis, they seem to be choosing gold. So gold has been doing well. It's been volatile, but it has been moving higher. Platinum's not been that lucky. And of course, what they want most of all is dollars. You can see that the US Fed has been trying desperately to keep the dollar weak. Nobody wants, in their opinion, a strong dollar. But of course, investors want dollars. And so there's this constant upward pressure on the dollar. We now have a situation where the US Fed has basically opened their swap facility to the whole world and saying, if you want dollars, come to us, we will give you dollars, in an attempt to prevent the dollar from appreciating too dramatically. But that's been the preference of investors so far. They've sold out of equities that they perceive to be high risk. They've sold out of bonds initially, low risk government debt. They're now returning to that. They've bought into gold and they've bought into US dollars, just pure, plain, hard currency, the so-called dash for cash. Now, obviously, all of this reflects the real economic impact, and that as a result of the containment measures of COVID-19, you've had this sharp shock to global demand, which has literally just imploded. And the response, the policy response globally needed to be strong, it needed to be powerful. And so the monetary authorities globally were, of course, the first to respond. As you can see here, this shows you interest rates in your major countries. And you can see the Fed is the only one that really had any scope. because their interest rates, they had been normalizing it over the period basically from late 2015 to early 2000, well, about mid 2018. So their interest rates were much higher, and therefore they had scope to cut interest rates, and they did so dramatically. They completely reversed the hike in interest rates, or the normalization in interest rates that occurred over the last couple of years, and they reduced their interest rates by 150 basis points to only 25 basis points. The UK followed suit. They also had a little bit of scope, but only a little bit of scope. And as for the Eurozone and Japan, they had no scope because their interest rates are already negative in real terms. All right, nominal and real terms. The other thing, of course, that central banks the world over have done is they have injected massive amount of liquidity into the financial system and into the banking sector, and of course also into the financial markets in general. The Fed has opened its facilities very wide, even allowing small companies and companies in distress to access bridging finance through the US Fed. So what you can see here is what's happened to the US monetary base. In simple terms, everybody's printing money again. The US, this is their monetary base. You can see during the financial crisis how they started printing money and continued printing, trying to get the world economy back into some form of momentum. And then as we saw growth take off very comfortably from around 2013, they indicated that they were going to start mopping up this liquidity out of the market, and the so-called unwinding or tapering of the US quantitative easing program began. Now all of that is being reversed. The Fed is again pumping a huge amount of liquidity into the market. The fact that the US Federal Reserve has slashed interest rates, that they are providing liquidity back into the market, especially dollar liquidity, has made it possible for most emerging markets to also cut interest rates in order to ease the pressure on their economies. And so they have done so. You can all get a copy of this presentation either through John or myself. John is probably the best one to distribute it because he would know who to send it to. And you can look at the details. But just to indicate, this is a busy graph, but it just shows you the overall trend, even in emerging markets, are down. So we've had the shock to the global financial system. We've had the shock to the banking sector globally. We've had this enormous policy response, first from the monetary authorities, and then in the fiscal case, we've also seen governments across the globe, despite the fact that almost all of them are already sitting with very high debt levels, introduce even further stimulus packages. In the case of the US, you are talking of stimulus packages of over $2 trillion US dollars. Right now, the bulk of that is actually directed at preparing the healthcare sector to deal with the crisis. So almost all of the stimulus at this point is going into the healthcare sector. It is going into unemployment insurance. So it is helping those who have lost their jobs as a result of the COVID-19 crisis. And it is going into businesses experiencing severe cash flow problems as a result of the containment measures to deal with COVID-19. All right. Now, what is the quantum of the decline? We know we're going to go into recession globally. That is obvious. If you shut down economic activity, you are talking about very extreme decline. So how bad can it get? The problem is that we don't actually know. We can only use high frequency data in your advanced countries to get a sense of that. If you look at China, it gives us a sense of what happened when they, remember ahead of the curve, because that's where the virus originated. So they had their main lockdown in February. They started to implement containment measures January, extreme containment measures February, and in March they slowly started to open up their economy again and restart production. under very different circumstances, but nonetheless they did so. So they provide a bit of an example of what we can expect. If you look at industrial production in China, it already contracted in the first quarter. Then it fell by, what is it, almost 15% in the second quarter. That was the period of the lockdown. And then even after they opened up in March, industrial production still declined. Why? Because demand didn't recover. Not as quickly and as rapidly as they may have liked. And this is the reason why, if we go to retail sales, you can see again, very sharp decline during the lockdown period in China. But even after the lockdown, in March, retail sales still declining, still shrinking. So demand remained weak. And why is that? Because obviously individuals, consumers, households remain fearful of going out there and shopping like crazy or walking about too much, because they still remain fearful that the virus might again strike and might still be out there. And so this is not something that is going to go away the moment you start your economy again. From a Chinese perspective as well, is even though they opened their economy in March, and if you're producing goods, say industrial production, you need to sell it either domestically or you need to export it. So domestically, their consumers were reluctant to return to the shops in full force. So that kept sales contained and declining further. And globally, most other countries were still in lockdown. So where do you export to? Mars? That was basically your only option at that point. So that's why you saw that still declining. The implication for China's GDP is that they recorded a contraction in GDP for the first time on record. That's how dramatic the effect is. On a year-on-year basis, in the first quarter, China's GDP contracted by 6.8%. In the US, we're also starting to see the real effect of COVID-19 come through. This graph here in green shows you the amount of jobs created on a monthly basis in the United States, and the red line shows you their unemployment rate. And in March, when the US was not yet on the sort of at the most severe point of their lockdown measures, they were still iffing and imming about whether they should proceed more aggressively. And it's really in April that the US has been, late March, early April, that the US has been under more strict sort of containment measures, quarantine, social isolation, and even shutdown in some cases and in some states. Particularly New York. And if you look at their unemployment, just in March alone, almost 6.2 million jobs were shed, and their unemployment rate shot up from just over 3% to just over 4%. That is a very dramatic move. If we look at the weekly unemployment insurance claims, essentially I don't know if you can see my arrow, but essentially in April so far, through March into April so far, all the jobs created since the end of the global financial crisis have been wiped out in the space of less than 2 months. So the impact is going to be very dramatic. What does this now mean? There are less people earning an income, less people with the ability to spend. When you open up the economy again, yes, there'll be some employment, but companies are not going to immediately employ all the people they needed to retrench. They're going to wait and see what happens to consumer spending, what happens to demand. So this thing is going to have a ripple effect into the rest of the second quarter, even if the world economy opens up in May, and probably also even into the third quarter as well. So what has it meant for US retail sales? There you can see I've got US retail sales going back to 1993. In March alone, which, as I mentioned, is not the period of the most strict containment measures in the US, we saw that their retail sales shrunk by 6.2%. We're probably going to have in April an even more dramatic decline. Some of the forecasts out there is putting estimates at -15 to -20%, which would exceed the type of declines we saw at its worst during the recession that followed the global financial crisis. A similar story for industrial production. It contracted by 5.5% in March. It's still a way off from the kind of implosion we saw during the global financial crisis, but the general anticipation is it's going to get very, very close once we get the April numbers. So already you can see the quantum coming through of these containment measures. You're not talking about declines of 1 or 2%. You are talking about declines of really anything over 5 to 20% on a monthly basis. And as a result of that, what we have seen is that most of your forecasters out there have adjusted their forecasts for GDP and for world growth. But just to warn you, the reality is, and I include myself in this, there is really no economic model that allows you to model the impact on the economy of this kind of measure. Economic models measure relationships, say, between consumer spending and disposable income. They give you a coefficient which is supposed to be stable, and you use that coefficient to forecast what might happen to consumer spending based on what you believe will happen to income in the years ahead. What it doesn't indicate and what it cannot prepare you for is a situation where everything comes to an end, where all production ceases and where consumer spending falls by what? 40%, 30%? And you see that in the global forecast. This is the market forecast. This is the Reuters consensus market forecast. Here in red, you see the low. So this is those individuals that are expecting a very weak global economy. So this is the lowest or the weakest forecast out there. Then you see the medium forecast, and then you see the ones that have remained fairly optimistic. So that is your highest forecast out there in the poll. And what you can see is that everybody, the medium comes out at a contraction. So for the world, it is anticipated to contract 1.2%, the US by 3% this year, the Eurozone by 4.5%, the UK by -4.1%, Japan by 2%. Only China is still anticipated to grow based on the medium of about 2.4%, but at a much slower rate than we saw last year when they grew about 6%. All right, so China has slowed down, but not an outright contraction of the economy. But you can see the variation. Just take the United States. The weakest forecast in the poll suggests that the US will shrink by 8% there. And the best one suggests it will still grow, but at a much slower rate of 1.7. The difference between this is basically 12%. So that's how unreliable forecasts actually are. And nobody really knows how significant this the quantum of the decline will be. And the great variation in these forecasts reflect that. But I think the thing that is safe to say is that the yellow bar is probably pretty accurate, and that we know, these green bars are not likely. You are going to see a contraction in global output. The IMF came to the same conclusion. This is the IMF's forecast based on the World Economic Outlook they recently released. And you can see they expect the world economy to shrink by 3% this year and then to rebound with growth of 5.8%. So if it shrinks this year by 3% and it rebounds next year, the yellow bars next year by 5.8%, it means it ends 2021 at a slightly higher level than prevailed prior to the outbreak of COVID-19. For the US, they're not that optimistic. They expect the advanced countries to shrink by 6.1%. So they take the biggest hit, and they bounce back, but only by 4.5%. So they don't return in 2021 to pre-COVID-19 levels. So that gives you an indication of how this impact is anticipated to have a ripple effect into 2021. They're quite upbeat about China, and quite a bit about emerging and developing economies, but predominantly because of China. They do expect that China's economy will accelerate dramatically next year. A big reason for that is that China has, of course, the resources. They don't have very high public debt levels. They have high debt levels within their state-owned enterprises. They've got high debt levels within their banking sector. They have all the issues around shadow banking, but the government is in a position where they can accelerate fiscal stimulus. And of course, they also eased monetary conditions dramatically. And that is expected to have quite a significant impact in China. And also, they're ahead of the curve. So the worst of COVID-19 economic disruption is behind China. For sub-Saharan Africa, they do expect that by 2021, sub-Saharan Africa would have returned to levels higher than what prevailed prior to the outbreak of the virus. And then for South Africa, they're not that optimistic. They expect we'll shrink by about 5.8% this year, grow by about 4% next year, which means we won't return to levels that prevailed prior to COVID-19. All right, that's the detail. I'm not going to go through it. You guys can, by all means, get this presentation. That is the IMF World Economic Outlook. This is the detail for some of the countries. If you find that useful or it's a market for you, then and you want maybe even more countries added to that list, you can always give us a call and we can send you that information. Now moving on to South Africa. As of yesterday, this was the COVID-19 graph or progression of the virus in South Africa. And again, our rate of progression has been a little bit slower than the rest of the world. We responded fairly early. Initially, if you look at these green bars, which is your rates of new infection, it looked like we were going to join the likes of China, of Italy, of Spain, and then of course they imposed the lockdown, and then to some extent they helped to flatten the curve, and it certainly did flatten. But do bear in mind that in the case of South Africa, we haven't done nearly the amount of tests that we can say that we have a fair understanding of the prevalence of the disease within the broader population. So the number of tests we have done of COVID-19, it's being rolled out and they're trying to speed it up as quickly as they humanly possibly can. But for a poor country with limited resources, that's not the easiest thing to do. But what it simply means is that the number of tests we've done are not yet sufficient in quantity to get to, so that we can comfortably say we have tested a fair representation of the population. I don't think South Africa is there yet. And that is the worry going forward. So even though it looks like the rate of new infections certainly have flattened, certainly from that initial spike, we don't have enough tests representing the average population to come or draw any significant contributions. On the financial markets, the impact on South Africa has been very similar to the rest of the world. Our equity prices took a big hit. And then, of course, also that was in the spike in global risk aversion as the world became aware of the rapid spread of the virus and the likely economic consequences of the containment measures. That got priced into South Africa immediately as well. And you can see that since then, there's been some pullback specifically in basic materials, but financials and industrials also a little bit better off their lows, but still very, very depressed. The bond market, the government bond market, was hit not only by COVID-19, but also by the downgrade of South Africa's sovereign credit rating to junk status by Moody's, and even deeper into junk status by Fitch. And consequently, the combination of that resulted in a severe dysfunction in the South African government bond market. You can see how yields just shot through the roof. And on your R186, which is your most liquid government bond, that shot all the way up. And then your R213 which gives you an idea of your more or less your sort of slightly over 10% maturity range. That also shot up dramatically. And consequently, you know, it did force the Reserve Bank to act. What resulted from that was that the yield curve, in other words, your yields based on maturity, if we look at your yield curve, it went from the yellow line, which was prior to COVID-19, all the way to the red line. So it was a very, 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 very steep yield curve. That shows you the level of risk that was really discounted into the yield curve. At this point, the South African Reserve Bank decided to step in, and they have started to buy government bonds. And of course, this yield curve represents the borrowing cost for the South African economy. It represents the borrowing cost for government. And the Reserve Bank stepped in, they started to purchase bonds, and they have managed to sort of calm and reduce and flatten the yield curve a little bit to the green line, which is where we were yesterday. And the problem, of course, is that foreigners completely sold out. This graph shows you net foreign purchases of South African bonds and equities. You can see foreigners have lost interest in South African equities a long time ago, so they're not buying into the equity market or the stock market. They've been in and out of the government bond market, mainly because, of course, we offer very high yields and we have a very liquid bond market. And the moment the Reserve Bank started buying, you can see they came back into the party. And so foreigners sort of started to return there at the very end. I don't know if you can see this little graph sort of bottoming out. And just that was enough to bring the yield curve down a few notches. So that has been the effect. But overall, you can see it's falling again, and that's where the pressure is. All of this risk on, risk off sentiment globally and locally, of course, were reflected in the rand. The rand fell very sharply, and the rand remains weak. And of course, if you had to compare this COVID-19 rand crisis to previous rand crises, how bad is it? Does it compare? Is it the worst we've had? It's not quite the worst we had, but it's heading towards that. This graph shows you all the previous rand crises. The 1996 rand crisis, the 1998 rand crisis, that's the green line here, which was, of course, the emerging market crisis. Then we have here in a kind of sort of mustardy green, you have your 2001 rand crisis, where two things happened. It was just after the dot-com bubble burst. Argentina defaulted on its debt, and in neighboring Zimbabwe, the land grab started, and there was a fear it would spread to South Africa, and that spiked risk aversion towards South Africa by foreign investors, and as a result, they sold out of the rand and sold out of South African assets, and the rand came under pressure. Then we had the 2008 global financial crisis. That's the big one. That's the red one. Not only was it sharp, it lasted a very long time. And then we had Nenegate in 2015, which of course morphed into 2016. Here on your x-axis, you can see essentially the number of days the crisis lasted. And where we are now, that's 2020 is the black line with the green, with the yellow dots. And you can see we are very close to what happened during the global financial crisis. This might be a period of consolidation. We might see that the worst is over and the rand starts to recover now, in which case the global financial crisis will keep the crown as being the worst rand crisis ever. But if it doesn't, if risk aversion prevails, then you might see the rand fall even further. All right, so how did the Reserve Bank respond? Well, they slashed interest rates. That's the first thing they did. They cut interest rates very sharply. 100 basis points in March, 100 basis points in April. So that's now collectively with the January cut of 25 basis points, that means interest rates are now down 225 basis points. They also stepped into the money market where they did pick up strain, and they widened and broadened the scope of liquidity they provided to the banking sector. In March alone, they provided 45 billion rand in liquidity to the banking sector and the money market. So, and they'll probably continue that for as long as the crisis persists. And then, of course, as you all know, they started to buy government bonds. In March, they bought about R1 billion of government bonds. In a market of over 3 trillion rand, that's not a lot of purchases, but it's certainly, they stepped in at a point where no one was buying, and that was the little spark that was needed just to calm the mood of investors. So financially, we've had a very similar pattern play out in South Africa than we've seen across the globe. Our equity prices have gone down, our bond yields have spiked. That's the only difference between us and low-risk countries. And then, of course, our currency has taken a mighty hit. And that is where we are now. Interest rates have been cut to deal with it and to counter it. And of course, there's been all sorts of interventions by the central bank into the money market and the bond market. So what will be the economic impact? I think the first thing to bear in mind is that South Africa was extremely vulnerable before COVID-19. We were already in a situation, this graph shows our quarterly GDP, where we entered the second technical recession in the space of 2 years. Our average growth rate over this particular business cycle is only 0.9%. So we were less than 1% economy prior to COVID-19. Government is in no position to roll out the sort of stimulus packages that will be needed to really give the economy a lift and support the economy through this lockdown phase. They'll have to do something because they are the only party that can do that. But unfortunately, they are in no such space. They've been running persistent budget deficits. The last budget in February this year indicated that we were going to have to live with deficits around the 6% of GDP level. Now, with the additional spending of rolling out and increasing the payment of your social grants, and also providing greater support through the UIF system, and also providing support to small businesses in distress, that deficit will increase. Added to that, government revenue will implode because you've basically shut down the economy. So the estimates at the moment is that this budget deficit will probably be revised and that it will hover around 10% of GDP, which is really enormous. That means our debt burden will climb even further. We're already above the sort of sustainable cutoff for government debt. It's already over 60% of GDP. According to the Reserve Bank, if you add the debt that will have to be undertaken during this crisis as a result of increased government spending and the collapse in tax revenue, you're probably going to see our debt burden rise to 100% of GDP. It might be even over 100% of GDP over a 3-year period if you add the debt of state-owned enterprises. So government will have to do something, as they have been doing, because they're the only party that can financially do that. But they are going to sit with an enormous debt burden. They are going to be financially in a very, very vulnerable state when this is done. Now, the other question is, can the market absorb the increase in government debt issuance? That's why I think it is important that government investigates, just like all other African countries, the possibility of getting more flexible and reliable financing. We've taken a $1 billion loan from the New Development Bank. We will probably need more than that. And there is the IMF. They are providing liquidity to many African countries at greatly reduced levels of conditionality. So it is an option. There is the World Bank. Equally, they are providing liquidity at greatly reduced levels of conditionality. So in this crisis, nobody is being too picky and too choosy and too demanding in providing liquidity. They understand that the world have really hit a brick wall. And so emerging and developing economies, that strain is going to be that much worse. All right, so what's the implication of all of this for South Africa? Government will increase its spending. It will emerge from this crisis financially substantially weaker. That has implications for the rand. It has implications for the cost of borrowing going forward. Over time, government's cost of borrowing will increase because the risk attached to such debt levels will be much higher. Added to that, of course, your rand will probably be weaker. If there is greater risk aversion, the rand will probably be weaker. So the rand might pull back a little bit, but it isn't going to necessarily return to the sorts of levels we saw prior to the crisis, because the general weariness of South Africa's financial position among global investors will undoubtedly have increased. So if we look at the actual physical impact on the real economy, this is consumer growth and consumer spending and growth in disposable income. And you can see it's been very weak. Disposable income growing by less than 1% on a quarterly basis. That's contained growth in consumer spending to less than 1% on a quarterly basis. And of course, that's going to worsen now. There's little doubt about it. What will be the impact of COVID-19? Well, we know that some companies are already experiencing severe cash flow problems. We know that most of them, as a first option to try and control their cost, have basically canned or postponed or delayed all capital expenditure. So capital expenditure, fixed investment will contract sharply this year, and it's not necessarily going to recover very quickly next year. That will really depend on whether demand globally picks up or not, and whether demand locally picks up or not. And that, of course, if a private firm is not going to expand their operations over the next 2 or 3 years, they're not going to employ more people. But never mind what will happen over the next 2, 3 years. Right now, if cutting capital expenditure isn't sufficient to keep you alive as a firm, your only other option is to send workers on unpaid leave. Now, many companies have done that. And that means that their less income, that individual is going to earn less money this year, and their disposable income will contract. If they are re-employed after the crisis, at least that sacrifice won't have been a complete waste, because they'll still have a job to go back to. Even if you are not put on unpaid leave and you work for a big firm with quite healthy cash flows and with substantial retained earnings and savings that can carry them through this very dramatic disruption, even then, profitability is going to be hit. Companies will probably record losses, and as a result, they will definitely contain wage growth in the years ahead. They will even maybe this year ask staff to take pay cuts, and they'll certainly scrap bonuses. So no matter which way you look at it, it's going to hurt income, even if people remain employed. But the greater likelihood is that some companies will fold, and some companies will have to retrench workers simply to stay alive. So we will have two effects come through on the consumer. We will have increased unemployment, okay, and we will have a sharp reduction in disposable income, which will limit the consumer's ability to spend even after the containment measures around COVID-19 have been lifted. Okay, the only thing working in the consumer's favor at the moment is, of course, that inflation remains low. Food inflation, it's ticking up, but it is still contained. Okay, so that's the only positive out there. The other positive, of course, is that global oil prices have literally collapsed. And this is some of our scenarios around global oil prices. You can have a look at it. Our view, though, is that there is tremendous amount of excess capacity at the moment in the oil market, despite the cuts that OPEC has put through. So oil prices, in our opinion, they're not going to bounce back quickly. They'll start to drift higher next year, and probably a little bit higher the years thereafter. But you know, at most, you're going to see over a 3-year period. That's how long it will probably take for oil to return to about $60 a barrel, which is where it was prior to the crisis. So oil is going to be another factor containing inflation and containing prices going forward. The rand, though, will be a negative. The rand, in our opinion, will stabilize. It might even pull back a little bit in the very short term, but we still think the rand overall will remain at a weaker level than prevailed prior to the COVID crisis. The reason for that being very simply that there is a higher risk attached to South Africa. What does that amount to if we look at it in terms of the rand dollar and the rand euro? You can look at these numbers. So what we see is we've had this decline, and we now expect that the rand will probably hover at a lower level, maybe pull back a little bit during the course of next year, and then start to depreciate, align with inflation differentials going forward again. So from an inflation perspective, you have an economy that's going to be very weak, higher unemployment, reduced disposable income, falling domestic demand. That means you're going to have a situation where retailers, wholesalers, manufacturers cannot pass cost increases onto consumers very simply because the demand isn't there. Demand is shrinking. So if you increase your price, your volume is going to implode and you're going to lose market share. So that's going to be a factor containing inflation, weak demand, or in the Reserve Bank's speak, if you like, in their lingo, a widening output gap. That's what they refer to when they use those terms. So your demand falls way below your potential output, and as a result of that, that reduces pricing power of businesses and it keeps inflation contained. The other factor that will keep inflation contained in the short term is low oil price. In fact, an imploded oil price, a sharply lower oil price. And even though the rand is weaker and is likely to stay at this weaker level, the truth of the matter is the implosion in demand and the implosion on oil prices will keep inflation under control this year. So the Reserve Bank does not have to worry about inflation this year. They've already cut by 200 basis points. We know that. Well, 225 this year. Will they cut again? They probably will. We think they'll cut another 25 to 50 basis points. We're undecided on whether it will be 25 or 50. And then they'll probably keep rates flat for an extended period of time. And we are expecting some normalization in interest rates as inflation starts to move a little bit higher towards the end of next year, sorry. So that means interest rates remain very low. Will it boost consumer spending? No, it won't. The only way you're going to get the economy to recover is you've got to lift the lockdown. And you've got to gradually lift the lockdown. That will be the first factor that will help the consumer. Then, depending on how quickly businesses can restart, employment will matter, whether people get re-employed or not, whether they're going to earn an income or not. That matters a lot more this year, and on what our GDP tally will be at the end of the year than interest rates. How does cutting interest rates help? Well, it might provide momentum to the economic recovery next year, so that's a positive. And also, it will certainly help people to service their debt. It will make it a lot easier for them to service their debt. And because it's going to be a lot cheaper to service your debt, it will free up a little bit of income for you, which you might be able to use on discretionary spending if you choose to do that, and if you're confident enough that the recovery will last. So it's just really almost a pressure relief valve. It doesn't stimulate this year. It could stimulate next year, but this year it's really just a factor to help the overall functioning of the economy. So what do we think will happen to consumer spending? That's the next slide. This is our forecast. Again, like I said to you, there's no economic model that can accurately capture what might happen. What makes it worse in South Africa is Statistics South Africa has delayed all the high frequency data from retail sales to wholesale sales to car sales to manufacturing production to mining production. So really only once this virus have come and gone and the containment measures are over and done with, will you have an indication of what happened in March and April. So that means right now everybody's just guessing. So what did we do to make our guess a little bit more of an educated guess? What we did is, for example, for every industry, for retail sales where we have some granular detail, we went and we said, okay, food sales will continue, cosmetics and personal health, personal care and hygiene products and health and pharmaceuticals, that will all continue. Certain general or specialized food stores can stay open. Everything else won't. So whether it's semi-durables, whether it's non-durables, and basically there we slotted in zeros for as long as the lockdown continued. Then we made some assumptions on what will happen to food sales and to pharmaceuticals and to personal care and hygiene products, and we put that into our forecast. And that gets us, and we did the same for manufacturing and we did the same for mining. And that gets us to a contraction in consumer spending of minus 2.2% this year. Very dramatic decline in the second quarter and a bit of a bounce in the third quarter. And then the consumer does start to spend again, but really you're returning to the same sluggish pace that prevailed prior to COVID-19 and off a lower base because employment doesn't recover as quickly, because in South Africa it is very slow to employment is very slow to increase once economic growth recovers. So for fixed investment, to take you through that quickly, we also expect, while we had sharp declines prior to COVID-19, the real cause of the trouble then was a lack of reliable energy. We still have a lack of reliable energy. So the moment we start growing again, energy supply will again become an issue. Eskom could have used this time apparently to do maintenance, but as I understand, that's not actually happening to the extent that we would have liked. So there's no guarantee that once we put this crisis behind us, that we won't still struggle with energy issues. So what do we think will happen to fixed investment? It will contract very sharply this year. That's our worst case. That's our best case. Our sort of average is it will contract almost 15% this year. It will remain negative next year, and it will only slowly recover 2022 onwards. Exports will, of course, take a big hit. There is some good news from the export side. If you look at mining, they have now allowed mines to return and to open up again, and they are allowed to produce to 50% of their capacity. Why 50%? I don't know. It really shouldn't be about how much you're allowed to produce. It should be whether you have put in place those sorts of measures that will ensure the safety of your staff, ensure the spread of the virus. And if you've put that in place, you can produce 100% of capacity. That is what it really is, where the focus should be. If you can provide government with the assurance that you have put in place dead certain containment measures, I don't see why you're limiting the amount of production that is allowed to occur. Never mind, that is the way government's gone about it. But you can see that the bulk of mineral exports do go to Asia, where they have opened up. There is going to be some demand coming from there. So that could help us through this period. And then the rest, of course, goes to Europe. All right, so Europe is still very much in lockdown. In Germany, they started easing restrictions yesterday. So maybe we can anticipate a better performance from May onwards coming from Europe. Manufactured exports, the bulk, of course, goes to Europe, which is still in lockdown, and the rest go to Africa, where I think we haven't seen the worst of the disease yet, or the virus yet. That must still come. And then, of course, manufacture is also very dependent on imports from Asia. That should normalize, but also from Europe. And that might affect your supply side. Of course, for agriculture, your biggest market is Africa and Europe. In Africa, I think the worst is still to come. We can only hope that Africa learns from the experience everywhere else, because we are behind the curve. And I am pretty sure that the world, and especially the World Health Organization, will provide a tremendous amount of support to Africa through this time. And then, of course, Europe, that should start to open up around May, June. So your market in that regard won't necessarily be affected. So what does it come down to in GDP? This year, we're anticipating a decline in our overall economy of -7%. Next year, things improve, but we don't return to the levels that prevailed prior to the crisis. We grow by 2%. So in many ways, if you want to think of South Africa's of this crisis, is it a V-shaped recession, a W-shaped recession? It's an L-shaped recession. We take a knock and we stabilize at a lower level. Okay, so that's how the level will look. Here's the detail of our forecast. As I said, you can get a copy of the presentation. You can run through it yourself, and hopefully it's provided you with a bit of insight on how we see things progressing.
Thank you, Nikki. That was really insightful. Everybody, I think if we all wondered about whether we are in trouble, the answer is we are.
Yes.
So, thank you very much for sharing this with us. We will distribute it to all our members. And yeah, so thank you. We just want to say it was very, very insightful. Okay.
I'm glad. I'm glad.
Thanks,
okay. Keep
okay.
well and look after yourselves.
Thanks.
And stay safe.
Thanks,
all
Nikki.
right.
Bye.
Bye-bye.
Okay, next is let me just check my thing. Is so Paul is not on the line. So Tony, are you there?
Yes, I am, Omri. Thank you. And I think our president, Fiona Simpson, is also on the line. So perhaps we could give just a couple of, 1 or 2 minutes each, and then perhaps we can take some questions if that suits you.
Wonderful. Okay, you guys can go.
Thank you very much. Fiona, are you there? You want to perhaps start, and then I can finish off?
Yep, sure, Tony. There's a bit of how we go. Hello, everybody, and Omri, and thank you so much for today. What's happening in Australia? I'll say doing it an all right job at managing this virus, and the National Farmers Federation trying to ensure can do much business as usual of the national farmers, which means that I'm a farmer and I live in Wales on a mixed farm where my family crops. So we crop summer and winter crops, as well as raise beef cattle. To the virus. Lovely to have some widespread rain, and so starting to recover again. NFF members are the organisations that represent farmers across Australia. So we have 8 organisations, we have the groups, and they all come together for issues that are nationally managed. And of course, COVID is one of those issues that has had to be managed at the national level, even though then the and the implementation of those decisions has had to be done at the state level. And that's where, so we've been very much engaged at the getting to make sure that we can, as an industry, well as we can, in making sure that. So I'll hand over to you now, and you can talk a little bit more about our COVID response in particular.
Yeah, sure. Thanks, Fiona. I hope everyone can hear me okay, and thanks, Omri, for the chance to have a quick chat today. So in terms of COVID, we, as I think the previous speaker has said, that We are generally travelling okay as an industry. We're very quick to talk to government about the essential services, the essential nature of agriculture. As around the globe, there was a whole lot of panic buying here in Australia for products, and we were pretty alarmed about that, given perhaps like South Africa, we're a major producer of many of the commodities, and we took it upon ourselves as an industry to work really closely with government to make sure that they understood that agriculture was essential in terms of, after the health of the population, from an economic point of view, obviously to provide food and fibre and everything to the community. So they recognised that really quickly. So we developed up a list of essential services, essential sectors, essential activities and jobs that we gave to the government to make sure that agriculture could continue as an industry. And obviously from an economic perspective, as an industry, we were much less impacted than, you know, hospitality or services or education or tourism. So, I mean, the Australian economy has been absolutely devastated, like economies around the world. But by and large, the Australian farming industry has coped or is coping quite well. We've had a pretty good start to the season. We've had some rain after a long period of drought. So there's a lot of optimism. There's a lot of expectation around agriculture, not only continuing to function and operate right in the middle of the crisis, but now, because as a country and as an industry, I think we've coped reasonably well. The government's now starting to say to us, okay, so agriculture has been one of the sectors that hasn't been impacted. How do we make sure that we supercharge agriculture to help drive the recovery and help make sure that agriculture and a couple of other sectors can really lift the country and drive the country out of this economic crisis? So we're starting to put some thought around the policies and procedures and deregulate. What we're talking to government about is largely removing the barriers of regulation to allow industry to grow and flourish and take advantage of all the opportunities. So things like, for example, just to give you a really quick snapshot, things like moving to e-certification. So instead of getting, you know, certificates or protocols or standards sort of stamped in hard copy, moving to electronically do that, so it's a whole lot more efficient, that we can still keep our export markets satisfied as they start opening up, like China and things like that. The economies start opening up. We are so export dominated that we really rely on that export market. So that's a really small example of what we're saying to government is help reduce the regulation that is holding the industry down, open it up so that we can continue to grow. So we've still got some issues around consistency across, you know, the big country that we are in the various states. So the provincial sort of approaches is still causing us a little bit of grief, and the transfer of workers across the country is still causing us a little bit of grief as well. But by and large, the industry is going quite well. And the government has been really supportive of the sector in terms of, as I say, keeping the wheels ticking and of course, the obvious, maintaining the food supply to the population. So that's a quick overview. Happy to take any questions, Omri.
Tony, just a question from my side. Has there been any embargo on exports of produce, wine, wool, cotton, whatever you guys export?
No, there hasn't been, and in fact, the government has actually said it took them a little while, a couple of weeks, but they've actually put in place, you know, $100 million to actually assist exporters to keep their products going, to keep the export markets alive. So they've subsidised air travel and or freight to make it cheaper, because the airline industry has stopped and a lot of the produce went out in the bellies of passenger planes. They've sort of provided some funding to help charter planes and things so that we can continue to supply those markets. So in fact, it's probably the opposite. They've sort of said, well, we must make sure you continue to export because we don't want to lose those markets.
Thank you, Tony. Okay, let's take 3 questions for Tony. Keep it short and to the point. Anybody? Okay, doesn't seem that we have any questions. What is that thing behind you, Tony? You guys, your strategy, I read your strategy is to generate 100 billion for the agriculture sector in New Zealand, in Australia.
Yep. So it's what we call a roadmap for a $100 billion industry. So our industry is valued at 60 billion Australian dollars, and we have set ourselves a target to almost double that in the next 12 to 15 years to grow the value of farm gate produce in the next 12 to 15 years. So it's a strategy that's got 5 pillars, and we've given that to government and said, here's our plan to grow the industry. And in a really good way, the government has loved that and has actually adopted it itself and said, okay, well, we'll not only sign on to your industry plan, but we'll come up with our own plan that matches your roadmap, because we see agriculture as a growth industry. Agriculture, in terms of contribution to GDP, has reduced in the last few decades in Australia. I mean, but it's still a really important part, and the government has adopted that strategy that's behind me. So we're really pleased about that, that they've got behind that. But it's a work in progress for us. We're 2 years into a 12-year journey.
Okay, wonderful. I'll also share that strategy, if it's okay with you, with our members. I think it's very, very well done and very insightful. Congratulations with that. Okay, on that note, Tony and Fiona, thank you very much for joining us. I know it's evening there in Australia. You guys can go and have a barbie and have some wine. Whatever it is. There we go. You're already having one. Have some wine. Our alcohol sales has been restricted here, so everybody is like, the black market is alive and well here. But thank you very much for sharing your information with us, and like we discussed yesterday, continue to work together to see how we can learn from each other and better ourselves. Thank you very much for joining us.
Thanks, Omri. That'd be great. Bye now.
Bye-bye. Bye, Tony. Okay, next up is Johnny van der Merwe. Is Johnny on the line?
Yes, I am, Omri.
Okay, Johnny, are you gonna give us some insight from the AMT side? What are the agri-market trends? Let's try and keep it really like a executive summary version. Okay, over to you.
Hi, Omri. Yes, thank you. And let me share some thoughts with you guys. I'm not sure if you can see the slide at the moment that I put up for you.
Yeah, we can.
Okay. I just wanted to see that there was really interesting the past month prior to the lockdown, of course, and during the lockdown. And I think I've got a lot of points that is similar to Nikki from Nedbank as well. And I think we can expect basically the same amount of trends, or the same trend that we can see with the economy overall. And I think we can closely follow consumer spending, as this is primarily, as we've seen, the main driver of agricultural, or the food prices, of course, or the market prices. It was very interesting to see that prior to the lockdown, we didn't have let's say, a less demand or more supply or less supply. We only had a bunch, let's say, that the supply moved to prior to the lockdown, and we've seen the panic buying and so forth that resulted in some prices to spike, of course, and we've seen prices to trend downwards and to move downwards. When we look, and we're expecting, of course, similar to after the lockdown, that prices may stabilize on a lower level, basically purely on the fact that we're going to see lower per capita income, as that's said by Nedbank, and of course lower demand for food, and I think less demand for exports, of course, and food prices to stabilize on a relatively low level. This will, of course, be different for different fruit groups as well. We will see the shift in demand, of course, to move between the LSM groups. And not only, let's say, more to maize meal, from meat to maize meal, but within a certain livestock as well. You can see we have already seen, let's say, less steak sales and more mince meat and wors and so forth, and sausages. And we can see that shift in demand as well. What's some good news actually is I've looked at the livestock prices. When we look into the livestock markets, we have seen that we've currently with the week-on-week decrease in the price was 3%, but we're currently still 3% higher for the A class and C class, and on a similar level for compared to last year. For mutton as well, we've seen this currently we have still 17% higher A2, A3 price. The feeder lamb price currently approximately 3 compared to last year still. This was in spite of the lockdown and everybody saying everything is low demand. Of course, we've seen last year we had the massive drought, and the drought that came for a few years, I think 6 or 7 years in some areas. And I think that cushioned us. I think that one of the positives that we can take out of this is we currently have lower numbers, animal numbers, of course, entering into the market. And we've seen the higher prices last year actually low prices at the end of last year due to the ongoing drought. And as soon as it rained, we've seen especially your female animals that the prices went upwards. But I think the lower number of animals currently available is still cushioning us in terms of the low demand that we see, and we're expecting low demand still. So this, I think it may just postpone the herd rebuilding phase for a lot of farmers. And of course, we're expecting high input costs as the weaker exchange rate is definitely will impact on our exchange rate. Pork prices, and it must also be said, I just want to add on to that we're currently in a downward beef and mutton price trend, the same as pork, and we're expecting prices to move downward as we're currently in the weaning phase. And it's not, it's seasonality basically that is impacting prices at the moment. When we can see the real effect of this COVID-19 or the lower demand is prior to, I think, July, or if the price dips substantially below what we have seen traditionally. But at the moment, we're not that worse off in terms of beef and mutton prices. Pork prices also in a downward trend at the moment, and we're still seeing also higher prices compared to last year. Yes, poultry prices, we've seen, I think that follows closely if you look at the exchange rate, and that is also on a downward trend, but luckily we can see it's also higher compared to last year. I quickly want to show you the expectations or the seasonal trends when we look into feeder lamb prices or the wean prices, and we're expecting current prices. We're expecting for the next few months, we currently hear about at a low point, and that's seasonal. That's both seasonal prices and not taking the low demand of the COVID outbreak into account. So we're expecting prices to start gradually moving upwards as we're moving towards August, especially. But limiting factor will definitely be the decrease in demand, and we're expecting, of course, these prices, the A2, A3 prices, to be driven by consumer demand and the low consumer demand that may put an additional limitation on these factors, of course. The grain market, quickly, I just want to go through that. We've seen a very volatile market at the moment, especially for the near month contract prices. And we have seen, for instance, the white maize price, the April white maize price decreased by almost 600 Rand the last 2 days. That is a substantial amount. But I think the most important fact is, or price is, of course, to look into the July maize prices. And these prices are substantially higher than we thought. I think everybody talked about 2,000 Rand. And these prices are substantially higher, mostly due to the exchange rate that fell, of course. and or the weak exchange rate that supported these prices, of course. The white maize, we're still expecting a very good year, and yeah, that may put some pressure, harvest pressure on these prices as we're getting closer to July. The soybean and the wheat prices and the sunflower prices were more sensitive to the exchange rate, and we saw these prices that were extremely volatile with the exchange rate that nobody thought of the exchange rate and these prices at the moment. And but we're expecting these prices to stay on a high level, especially for wheat, and we've seen a lot of demand for wheat. These high prices, of course, are putting a lot of pressure on the livestock industry as well, on feedlots and so forth, increasing their costs. And I think that from the demand side, that's got less moving room. On the other side, it may increasing pressure on these industries, and yeah, maybe the result in the livestock prices to increase less significantly than we might think or than we can expect. When we look into the fresh produce markets, I'm not sure if Francois is also going to talk about it. We saw a very interesting movements on the markets. I think we've seen the importance of the informal sector, the hawker trade on the fresh produce market the past month or so, and we've seen they were not allowed to trade for the first week of the lockdown, and prices fell sharply during that time. And as soon as they were allowed back on the market, the prices stabilized to a certain extent. We have seen that especially the last 2 weeks, potato prices came under pressure, and prices are approximately it's approximately 14 or let's say 4% lower compared to last year. I think it's important to compare prices to last year this time. At tomato prices, we're expecting prices in April and in lesser extent in May to be very high due to slightly more export and lots of lower volumes, of course, on the market. And these, but it's currently 28% low, and I think it's due to we've seen that basically the storage value, or I'm not sure what the right word for the English is, but the longevity of the product is also having a major impact on prices, especially in the lockdown period. We've seen a massive increase in carrot prices, and last week trading on R8.31, and it's currently 70% higher compared to last year. High, of course, demand. Onions also very high. But what's very interesting is to see that garlic prices shot through the roof. It's currently 233% higher compared to a year ago. And we've seen that products, especially on the fresh produce markets, that's healthier orientated. I'll go to the next slide and see, especially like orange prices and so forth. We've seen a spike in demand and, of course, a spike in prices as well. Peppers and chili prices, it took a bit of a knock, but we're expecting fruit prices in general to trend downward now as we're moving toward winter, and that's due to seasonality. People moving more towards the warmer food and more towards the vegetable market. So expecting the fruit market to trend downward, but we have seen that banana prices recovered to a certain extent. It was a bit down just after the lockdown, but we have seen I think the most significant decline is the apple price that we've seen the past increased by 44%. And if you look into the apple price, the trend in apple prices, you'll see because it's got a high storage capacity, you can store it and feed it into the market. You'll see prices not moving more than 1% at most, 2% at most between weeks. And with a 44% decrease in price, it is a significant decrease. With other prices much more volatile on the market. This was due to, I think it was probably 80% higher volumes on the market. And you'll see, I think it comes mostly down from your retailers and the retailer demand that is much lower at the moment. When you look into the orange price, you see it's currently 61% higher compared to last year. And very interesting to note is we're moving into avo season, the higher, let's say, volume or the better season basically. And we've seen slightly higher volumes for avos, but we still have a 4% higher avo price currently on the market, increasing by 40%. It was slight due to quality on the markets as well. Luckily, I think the grape markets sidestepped most of the COVID-19 outbreak and this pandemic. They're nearing their season end, and I think lots of the volumes are really, of the local volumes are already through the market. But usually we see slightly higher prices at this current moment and prices to trend upwards. We have seen, interesting to notice, is also lemon prices. I'm wondering if that pineapple price is due to the fact that more people are brewing beer at the moment. So probably that's one of the major contributing factors in demand. But we have seen lemon prices also increasing substantially to higher health-orientated factors. So yeah, my in general, I think to sum up, I think we can expect prices to stabilize on a lower level, but I think the shift in demand between LSM groups will be a significant factor, and companies or agricultural or producers that can supply different markets, and it's more flexible in their supply chain and how they can access consumers will definitely be more successful over the coming year or so. And I think the major factor that will change over the coming year, to my opinion, is of course the supply chain. People that's got less money, and I think there's a lot more people that will be at home, either if they lost their jobs, or companies that have a stay-at-home or work-at-home policy. More people will stay at home, and I think that will have a significant factor on our food supply chain and change the way people consume food, which will definitely have a severe impact on different food groups, but also the segments within food groups that target different LSM groups.
Okay. Johnny, thank you very much for that. It's very useful. Can we distribute this with in our membership base as well?
Yes.
Thank you very much. Okay, so that was Johnny. Gerard Diedrichs from Santam. We've run over time, so Gerard, just 5 minutes. What's happening in the insurance industry? Guys are asking questions like if they transport cattle and the truck explodes, will they be insured? Just give us a short update of what's happening in the insurance industry.
Thank you, Omri. And insurance wouldn't be insurance if we don't start with a couple of provisos. But obviously, everybody needs to understand that each insurer uses his own policy wordings and terms and conditions, and that will apply. So you need to make sure that what is contained in your policy. And then obviously one of the questions will be, where does COVID-19 fit in? And obviously the purpose of insurance is to sort of cater for a large number of similar risks that happen over a period of time, which obviously exclude then COVID. But if I can use an example, because that's the question raised in terms of transit, is the producer will have a contract either by transporting his own commodity, and then he will make provision in terms of his own policy. Or he can make use of a transport contractor and then contractually have to transfer the responsibility of insurance over to his transport company, which then will take out the necessary insurance as picked by the client. So we must just make 100% sure of that. So if we look at the COVID-19, let's call it essential services, the claims part is definitely included in the ones that can continue. So obviously, if there's a claim and it's covered in terms of a policy, the insurers will go as far as possible to entertain that claim, handle it, and to finalize this quick as possible. But obviously, in terms of the value chain, if somebody needs to import parts to repair the vehicle or the truck, it might take a little bit longer. But the basic principle of insurance in terms of the request of the fiber side is that insurance can't be in terms of the regulations of a country. So if the fiber isn't classified as an essential service, then you're actually transgressing the Insurance Act, and it might be that you sit in a position that you can't have cover. But I'm participating in the session at 1 o'clock where the fiber guys will be present, and I've also asked the insurance industry to help me on defining what the principles will be. But I think the best will still be that we can get all commodities classified as essential services, then the impact will be the least. Obviously, from a Santam perspective, we still do quotes on new business only, but if a survey is required, that might cause some certain challenges because the writing of business isn't classified as essential service. So if you've got a mine and you want to move it from one company to another company, you'll have problems. Also, at the end of the day, if you haven't got previous insurance, but you want to start taking out insurance now, I think the clients will find it a little bit difficult with that as well. In terms of the increasing of your sum insured and including additional extensions, that will be subject to various insurance companies' own view. For certain stuff, we from a Santam side haven't got problems, like for argument's sake, you farm with a certain commodity, you've only make available a certain amount for your stockpile at a given point in time. And now, because of the fact that you can't transport that, your stock value is increasing, then obviously the insurance will look positive of that to allow you to increase that amount. A little bit.
Have you had an increase in insurance claims or not?
Obviously, there's close to nothing, no insurance policy that covered the COVID-19, but obviously there might be some big corporates that...
Sorry, wouldn't be that like an act of God? That's my
own. If you look at it, it makes specific exemption that dreaded diseases is excluded in the short-term insurance cover, but it's predominantly covered in the life side where you will have that life type of cover. But there's no correlation between COVID-19 and if you have a car accident, so it's not included there. So if there's some specific questions afterwards, then Ms. Lali can maybe circulate it and I'll try and answer each one individually. But if we look at from a Santam perspective, that was also a question, and we can't talk on behalf of the industry, but the group has made available 200 million to subsidize the smaller businesses and personal guys that struggle with the cash flow. But that via your broker or your financial advisor, you will be informed for what you qualified. But it might be, or it's definitely because of there's less movement or of vehicles. So your risk of having a stationary vehicle at home is much less than driving, and that will cause then the reduction in your premium. But you can also look as a suggestion from Santam's side that if your business isn't running or your private vehicles isn't running, then instead of insuring it comprehensive in this lockdown period, to change it to maybe only third-party fire and theft, but just make 100% sure that the hail risk is included. We've got a client with a lot of trucks, and due to the lockdown, all this trucks was accumulation of risk in a specific site. And in that geographical area 2 weeks ago, we had a big hailstorm. So the losses was quite tremendous. So just make sure that you include hail cover, because normal third-party fire and theft doesn't include hail. So if you go from comprehensive to a limited cover, specifically ask for hail. So that is in a nutshell. We'll give more information when we speak to the fiber guys. But if there's any questions, I know the time, we've run over time, but then I'll try to answer as best as possible.
Thanks, Gerard. We'll just share your details with the whole group. If there's any insurance-related questions. Okay, thank you for that. Francois, tell us what is happening with the auctions. I mean, there's been so many discrepancies, and tell us what's the story with the auctions and the markets, please.
Good morning, everybody. Morning, Omri. Yes, we've had some serious hiccups of livestock auctions. Predominantly, we've been blocked by certain police, and this is stock theft individuals that have been giving us a runaround as to whether we can actually operate auctions or not. So I've made contact with their legal chief in charge. It's a Brigadier van der Walt. We've had engagements the last week or so. The following is the outcome of that. Simply put, it's not clear in the regulations correctly whether there is room for auctions or not. They see it as gatherings, and they see it as illegal gatherings. And specifically in the Northern Cape, we've had some issues that they want to block auctions. So where we stand now, we've submitted through Agri-SA, you did that. There was a request put forward to Parliament. It's currently being discussed, so we haven't received any answer yet. The idea is to get auctions clearly defined in the regulations. The Minister has made mention that we should continue with auctions in a media briefing, and this was never contained in the regulations so that it can clearly be defined. So that's where we are. We are talking to the police. I think we mustn't see them as not working with us. Their only request is they can't see it in black and white, and they can't determine whether they have the authority or not to, allow it or not allow it. So that's where we stand. We should have an answer by this morning or later today, and I will communicate that with you and with everybody who's interested. On the livestock side, that is what we've been doing. I would quickly like to just allude to the fresh produce and specifically markets. I'll be brief. We've got 25 fresh produce market platforms in South Africa. This equates to about 17 billion rand in turnover that's going through those markets. Johnny has given us very valuable information, so I'm not going to repeat that. We've got 104 market agencies operating with 785 registered agents in South Africa currently. What has happened in March, and I'm talking specifically, I'm doing a comparison year on year and effective from the date of lockdown. In 2019, for the whole month, we did 1.35 billion rand turnover. 2020, the accurate figures that we received is 1.4. So that shows us a turnover growth of 3.58% going through fresh produce markets. Important part of this figure is what is the mass and what is the volumes, because that shows you the actual growth in what was sold. And that growth is 1.82%. So when the lockdown started on the 26th, we saw some panic buying. You can also see that in the rand per ton. The rand per ton for 2019 was 5,593. It grew by plus minus 100 rand per ton in this year, March 2020. But then just in closure, allow me some positives. I think many of the markets...
please, I think we need some positives.
Okay, then I'll take some more time. But positives, I think the protocols that were developed for markets, they've been rolled out to all markets, big markets, small markets across South Africa and across the country. They're doing a lot at market level. And yeah, I must give due to market agents and market authorities. Some of them are actually dishing out gloves. They're doing deep cleaning over weekends, and there's a lot going on. And I can report that markets are functioning very, very well. The fact that the regulations allowing informal traders were introduced has given us a massive boost. We must also see this in context of opportunity versus risk. As Johnny alluded to, we will see more buyers at the market. We hope that will stimulate the sales at market level. Then just quickly touching on basic foodstuffs, we see people interested in buying the basics. That's potatoes, onions, cabbages. Johnny spoke about a 4% reduction in the cost of potatoes, and we see that with specifically large potatoes. It's lower than normal, and this is simply accountable to restaurants and fast food outlets that are not allowed to trade. So the picture at markets, I think markets are under tremendous pressure now. There's not growth as we want to see. There's a lot of produce on market floors, and the general message is it's going really very well at market level. So I think that's a quick update. If there's any questions, we can discuss that at the end of this session. Thank you.
Thank you, Francois. I've got Annelies, but I think maybe I'll just cover Annelies and Jani. You would have seen we've sent a letter to the Minister of Agriculture, the Minister of COGTA, the DGs of both, the Office of the President, as well as the National Command Center with regards to specific commodities and some issues that we've been having with regards to auctions, etc., wine sales and things that just doesn't make sense. So we have, yesterday I had a discussion with the DDG about it. They have received the letter, they have carried it into the National Command Center. The intelligence that I'm getting is that there are dynamics in the National Command Center with regards to specific personalities and things that are not conducive to the greater kind of managing this crisis. It was very interesting to hear from the Australians how their government is actually fueling their agriculture economy. Whereas we have been almost contracted to the point that we have to get legal opinions, etc. So I think we are continuing the pressure that we're applying just to get common sense into the National Command Center, yeah. So I want to thank all of you for joining this conference. I think it was definitely the biggest one that I've been part of. I think at some point we were 68 people, and we know some people have to leave and so on. But we're doing this weekly, and we want to. The purpose is to keep you updated through your chambers. If there's any issues, please let Yolanda and Ms. Lali know. We will share this information with you. I mean, I think it was very, very valuable information, specifically the economics and the pricing and all of that. So I want to thank all of you for attending these conferences. It adds a lot of value and it gives us a lot of ammunition to take to government and to lobby them and to make sure that we remain in business. And in fact, in the longer term, that we will drive the economy going. So with that, I'm going to end the session now. Thank you very much, and good luck with your week. And stay safe, and remember to wash your hands. Thanks, guys.
Bye-bye.
Thank you, everybody. Bye-bye.
Thank you. Bye-bye.
Bye-bye.
Bye.